Hello and welcome to All About Your Company. Today we're going to be talking about a company which is dragged down due to two factors. One is US tariffs and it has a high exposure to the US. The second one is West Asia and it has exposure in the Middle East as well. And as a result of which you're seeing some pressure on the stock. Over the last 12 months, the stock has fallen 40%. And therefore, really begs the question as to whether we're at an interesting inflection point going into FY27 and whether FY27 or FY28's numbers will likely be materially better, just given that we're seeing a bit of a drag with regard to both the stock price as well as the business. We're going to be talking about Jash Engineering. It's the only Indian listed company which makes water treatment equipment. And I'm talking about equipment. I'm not saying EPC or executes projects in the water treatment space, but it actually makes the bare equipment. I'll talk a little bit about the product line, but let me take a bit of a step back. There's plenty happening in this space. US, West Asia, I highlighted that. But there's also UK and Penstock's acquisition, which they have done. How quickly does integration really play out is the other question within the UK geography as well. There's Europe as well, which it focuses on, Europe, UK, US. So exposure across the board, whether trade is getting affected, all of that and more on this edition of All About Your Company. Let me talk about the company now. It's a company operating in the water infra and industrial process equipment sectors globally. It was incorporated in 1973, in fact dates back to 1950 was when the original conceptualization of the company happened. And thereafter, what has happened is it's obviously currently sitting on a market cap of 2,600 crore with a very strong export-facing kind of an order book that it currently has. Let me talk about the products. First off, there's water control gates and related equipment, which basically controls the flow of water. This is a large part of the top line of the company. It has around 60% of its top line coming from, 50 to 60% coming from water control gates and heavy fabricated gates, just those two segments. And I'll talk a little bit about heavy fabricated gates as well. They're basically engineered to order. So basically it's made to order and controls water in large dams, barrages and flood control schemes. Therefore, when you're looking at that first couple of verticals in terms of the product line, the first set of products, which is water control gates, are used by municipal corporations, irrigation departments, water treatment plant builders, sewage treatment plant contractors and the like. And then you have heavy fabricated gates, which are understandably used in hydroelectric projects, dams, irrigation mega projects, as well as by flood control authorities. So that's really the tilt in terms of who the customer cohort is. There's no company in India which is doing this. 70% market share is what this company has in water control gates, and it's the only listed player which does it. Of course, there are certain regional players which do this as well, but far and few in terms of the cohort or options available to place orders. Then you have all of the other products that are there as well, and a lot of them. Let me just try and summarize. Those are names obviously for you, but to try and summarize this, it's basically everything relating to water infrastructure, whether it's cleaning, whether it's sludge. And sludge equipment is in fact even used in the cement plants, in paper plants, in paper manufacturing plants. So they've diversified to some extent, but all of this is a very small part of the overall business. For example, sludge is maybe 10 to 15% of overall top line in terms of contributions. And therefore, really begs the question as to the largest focus is predominantly water equipment. Really, that is the key in terms of the product line here. And water infrastructure. The other kind of story that's playing out in this space is the fact that India's water infrastructure and India's development, desalination plants and the like, there's very low to no presence of that in India. And as a result of that, the India opportunity itself is very, very large. Of course, once investments start to pick up, this could be one of those big beneficiaries in it. Archimedes screw pumps basically lift water up and bring water down by huge water bodies, lifts and brings down water within those water bodies. And it's one of those 2,000-year-old principles which continue to apply today. And Jash is one of those which manufactures this as well. the model of the company is such that they acquire brands in US, UK, Europe, and thereafter manufacture in India to sell to the customers of these brands in US, UK, Europe, and the like. That's broadly the way in which they operate globally as well. There you go. You've got Rodney Hunt, which is what they've acquired in the US. It's a big brand there, 185-year-old brand there. In UK, they've acquired Penstocks very recently. And then there's a brand in Europe as well that they have acquired. First they partnered, then they acquired in 2014-15. Okay, so that's broadly the take. There are knife gate valves as well that they do, which is basically a knife-like device which cuts through sludge, sludge which gets formed up in liquid, which is used in cement and paper plants and the like. We spoke a little bit about this all over the place in terms of product, but that's broadly the way in which the product suite is of Jash Engineering. Let me talk about manufacturing. 5 units in India, 1 in the US, 1 in UK. Their geography, 64% tilt towards exports in terms of revenue in FY25. Domestic is around 36. And why do I take FY25 is because to a large extent it's pre-tariffs and therefore gives you a better picture on what could be the kind of revenue share going forward as well. Also, we'll take stock of the order book, and that will also showcase that kind of tilt. Nearly 70% of the order book is tilted towards exports. When you're looking at the presence otherwise, it's present in 40 to 45 countries in terms of its presence. The business model, it wins orders based on brands that it has and it owns. I spoke about that. But also with regard to approvals, mind you, that's a key moat for a company like Jash. It's not very often that you will get a manufacturer of gates which is approved by the government to use those gates in say, flood control equipment. It's not very often. These are always given on the basis of approvals. And there are very few companies globally as well as domestically with those approvals. There's also China competition which plays a role, but the China competition is in less niche products than what Jash does. And therefore, that moat also is something that Jash enjoys globally, of course. So that's broadly the way in which to think of it. So they get their orders there. The order book is important, of course, to consider. Then they design, manufacture, and supply the equipment which has been sought for. They do it in a custom-made fashion as well as in a general fashion where they have certain standard equipment which is available. And thereafter, there's a 12 to 24-month tender delivery cycle which plays out, and that likely plays out over the next 12 to 24 months, depending on the size and the scale of the order. And they manufacture it in-house and thereafter supply it. Working capital cycle is structurally high because of the stretched kind of timeline, and we will talk a little bit about that on what the company is doing with regard to that. Let me take you through the financials now. And in terms of the top line growth, till FY25, we've seen a very decent kind of 26% growth clip over the last 3 years. We've seen a 39% EBITDA growth clip as well. So you've seen margin expansion play out. And then you've got profitability, which has grown at 40% over the last 3 years. So very strong surge in profitability up to FY25. But this has seen a bit of a knock in FY26. Let's look at the 9-month FY26 numbers in terms of the performance. And what you'll see is a 2% growth on the top line. EBITDA has halved. Margins have fallen sharply from 15.5% to 7.5%. And profitability has taken a knock of 63% for the 9-month FY26 period. So you've seen a very, very sharp contraction overall in terms of the numbers. And this is, of course, to some extent to do with how US has played out and how likely they are taking some bit of a hit with regard to cost due to tariffs. Now, let's look at the margin trajectory. And you'll see that the margins were on an improving trajectory. We stabilized at around 17 to 19%, and thereafter we've fallen sharply to 7.5%. Really, the goal is to hit a PAT margin of around 13 to 14%. That's the slightly long-term guidance. But currently, they're not doing that. And currently, they're finding it difficult to actually inch towards even 10%. But the goal is that FY26, they'll do 9 to 10% PAT margin regardless. And therefore, what we are hoping to see is a very strong Q4, which may be tough to speak about right now with management, but that is something that you should be penciling in. Let me talk about the order book as well, along with that margin commentary. In terms of the order book, we've seen the order book stand at 923 crore. Typically, the order book wavers between 1.2 to 1.5 times book. That's what it's been, book to bill. There you go. So that's order book to revenue, and you can see that out of the 923 crore, you've got around 650 crore, which is exports, and 270 crore, which is domestic order book. So around 30% is domestic in terms of the order book size. In terms of the balance sheet now, and it's no concerns with regard to the balance sheet per se. You're seeing equity plus reserves amount to around 450 odd crore, and you've got borrowing of around 100 odd crore, excluding lease liabilities, and then you're sitting on a cash of around 100 crore. So that's the broad brush breakup with regard to the balance sheet. No concerns there. When you're looking at cash flow, the cash flow conversion is proving to be tough because a lot of the cash is stuck in working capital, and that is one of the key drags on cash flow. But outside of that, the flow through on cash flow is not bad, if I were just to exclude that, but that's of course a concern. Therefore, from a conservativeness standpoint, we've given this a neutral rating. Let me talk about the return ratios, and return ratios, despite the cash flow drag, have been quite decent. You've seen as 20% plus return ratios, no concerns with regard to ROC where the company is seen. Let's look at the shareholding pattern now. Shareholding is currently promoter holding sits at 43%. FIs hold around a couple of percent, DIs hold 0.5% odd, and the balance is held by the public. Excuse me. You're looking at promoter ownership at 43, which is below 50, and therefore we've been cautious given this a neutral. But this is a multi-generational company, viewers. That is something to keep in context. Promoters will always likely continue to hold. When you're looking at valuations, and this is one of the key metrics, you're looking at FY26 expected revenue to be at around 800 crore. That's the latest guidance. PAT margin of 9 to 10%, which gives you a valuation, a current price to earnings multiple of around 33 times. When you're looking at the 1 year forward, though, analysts are extrapolating a 22 times 1 year forward price to earnings. I mean, even if, for example, they grow by around 10% at 880 crore and at an 11% kind of margin clip, that will roughly mean 100 crore of bottom line. Of course, not as good as the FY25 numbers, but that will mean that it trades at around 26 times. And therefore, what we've done is we've just been cautious. The 2 year average is around 27 times. We've been cautious. We've given this a neutral rating. You want to wait and watch as to what the management commentary is, whether the drags are over. And mind you, one more piece which I missed covering is the fact that on the margins, while you win the orders, they are fixed price orders. So they don't calibrate based on an increase in prices of raw materials, steel, commodity, etc. That also could be a key drag with regard to earnings in FY27. Let me bring on board Prateek Patel, Chairman and Managing Director at Jash Engineering, joining us this afternoon to give us a sense as to how business is playing out. Prateek, great having you. Let me first start off with what the West Asia crisis and, of course, the metals rally has done. You sit on an order book of around 920 odd crore. Does this to some extent dilute margins for you because of the fact that raw material prices have obviously gone up? And how much of an impact would that have on your margin number on a normalized basis? I know you guide for PAT margins more than EBITDA, so give us a sense.
So first of all, we have to understand that whenever raw material prices goes up, it is always linked with depreciating rupee. So the rupee is depreciating, which means our revenue in US dollars or in foreign currencies is increasing, and so our margins increase. So we are not that much bothered about the increase in the cost of raw materials, as the depreciating rupee also ensures that we get a lot more profitability coming out from the existing orders.
Right. So Prateek, that makes a lot of sense. And therefore your margins, you're comfortable with that kind of margin guidance, 10% for FY26, and thereafter maybe FY27, this will start to inch upwards. And if so, what would that margin number be that you would aspire for?
So generally our target is to have PAT margins within 13 to 14%, EBITDA margins between 21 to 24%, and this is possible for the type of business we are in. Once we receive scale of operation, which is what we plan for coming years, then these type of margins are easily possible. The only irritants could be external factors like the tariff in America or the war in Middle East. when something like this happens, it basically on the infrastructure industry, it has a lot of bearing. And so if these things are not there, then I believe the type of margins which we have predicted is easily achievable.
And let me talk a little bit about that. What's the kind of impact that that's going to have in on, say, the revenue of FY27? If, for example, the West Asia war were to resolve itself fairly quickly, what will that do? And if it were to prolong, what will that do to your revenue? Give us a sense.
We are projecting upward of 875 crore revenue for this year. Now that is around 18 to 19% over whatever we achieved last year. I believe we are safe in this projection because we have not gone very aggressive. We have been conservative as far as projections have gone. Our exposure to West Asia is there, but it is presently limited. And the biggest issue is about the tariff in America. I hope this stabilizes. Presently, the tariff applicable on us is 15%. We have been doing the estimates on 15 to 20% tariff basis. And if this continues, then we would be back in America. Our order book in America is quite strong. It is $40 million. And so, other than change in tariff midway, we don't see any big problems.
Pratik, are you absorbing the tariff? Is that what you've done all through last year? Tell us what has played out over the last year. And if, of course, there is some bit of resolution, there is some bit of chatter as well with regard to a resolution, what does that do both for you from an execution standpoint and from a margin standpoint?
So first you have to understand the modus operandi for us in America.
Yes.
Our American company takes the order, which is Rodney Hunt. And Rodney Hunt takes the order because they are approved. Just manufactures and supplies to Rodney Hunt. So when Rodney Hunt is supplying within their internal market, there is no tariff on them. But when Rodney Hunt buys from Jash, there is a tariff on Rodney Hunt. So if in between a tariff is changed, say earlier tariff in India to India was 0 and then it went to 25 and from 25 it went to 50. Now these type of tariffs were not inbuilt in our costing and so Rodney Hunt had to take the hit and since it is a subsidiary, Jash Engineering also takes an hit. So according to me, if tariff is there, but it's continuing at the same rate throughout the year, then we can estimate for it and plan for it. Then we have no problem. However, this did not happen last year, and that is why we were in problem. We had to cut short some orders. We had to decline some orders. We also did not deliver because we were afraid of the big loss we'll face on account of the difference in what we had considered and what we had to pay. However, the good news is that in February, the Supreme Court has said that these tariffs were wrong. And so we are looking this year or possibly next year at some payback on the tariff which we had paid. It could be anywhere from $1.5 million to $2.5 million, depending upon how the Trump administration pays back the tariff. So that is one of the good signs we have for this year as well as next year to get back something what we lost last year.
So, and that translates to roughly maybe 12 to 20 crore of tariff payback or refund, which you will get, which will reflect straight on your profitability. Is that the right way to think of it?
Yes, if I get it. The governments generally do not like to give back money. We read in the newspaper that they will give it. If they give it, we would be very happy.
Perfect. And what has happened now? So have you now started accepting orders? Is that what's playing out? Also, with the existing orders in terms of delivery, how is that playing out?
So now we have standardized production. Now we assume that tariff will remain at whatever percentage it is presently. In fact, now we are getting some advantages because post-June, we had estimated our products at 50% tariff, and this has now come down to 15%. So whatever we lost last year, we will try to make it up this year because of the difference in tariff going in our favor. So Yes, the tariff has stabilized, the production has started full-fledged. So once again, we are now looking at a huge improvement in our revenues in America. As I said, my order book position is already close to $40 million. Last year, we did in America $30 million. And now this year, we are projecting close to 39 to $40 million.
But that's not reflecting on your guidance, sir. So I'm trying to understand what is it that I'm missing?
So we achieved something like 736 crore this year, and we are projecting 875 crore, which is like 20% more. So it is in our guidance.
So the current year loss, right? So would you call the current FY26, or rather, by current year I mean FY26, would you call that the washout year, and that's something that you would completely ignore?
Yes.
Okay, okay, point taken. Give me a sense, this West Asian crisis, how is that impacting the business in Saudi, because you have presence there, and the rest of the world, because it's obviously impacting trade as well. Does it impact you in a significant fashion?
It impacted us because it happened in March. So most of the revenue is built in March, and when the war happened in end of February, it impacted us. On the annualized basis, the impact would not be very much because we expect it will be over in next few months. So whatever happened, tariff as well as the war, it was all in the last year, that is FY26. In FY27, we hope to come back to normal rate of growth as well as profitability.
And the business that you lost because of West Asia and the war, do you make up for that as soon as maybe as soon as there's a resolution, or that
Yes.
revenue likely will not translate?
No, those orders are there, the products are made, the products could not be shipped. So whenever war eases, I have to ship the products, they have to complete the projects. So anyway, we will be able to ship it out once the war stops and all the contracting companies, EPC contractors in Middle East starts project sites once again.
And how much is that? That's roughly 70 odd crore, if I've done the math right in my head.
Not that much, it is lesser than that.
Okay.
But together with America, Singapore, see, the war did not only affect dispatches to Middle East, it also affected dispatches worldwide. The shipping went haywire. There were no containers available. There were less number of ships. And as a result of that, many things which we planned to dispatch in March has not gone. So the hit was on account of that as well. I believe this should all stabilize, and the containers started become available now, and we are shipping material to Singapore, we are shipping to Hong Kong, we are shipping to UK also. The delivery times and the frequency is less, but things have started moving again.
That's very good to hear, Pratik. What about UK? You spoke about UK briefly. Let me take a cue from that. What's playing out there, and how is the integration of Penstocks playing out with regard to your operations?
So we first acquired in UK a company called Waterfront in Glasgow. This company was acquired 2 years back. Having acquired it, we realized that in UK they don't consider a Scottish company as a British company because they say it is Scottish. And so we needed something in the heart of England, which is in Midlands around Birmingham. And that is why we acquired Penstock UK. This is a small company, but it brings with its approval. So today, with these two companies, Penstock UK and Waterfront UK, we have a footprint across UK. And this would help us in establishing and growing rapidly in UK. We expect to reach 4 times the turnover in 3 years in UK from what we are currently.
Okay, 4 times the turnover, which in the next 3 years. So your current turnover in the UK is roughly 40 crore, if I've got that number right?
Little bit more than 40 crore, and we expect to do anywhere between 125 to 150 crore in UK in 3 years' time. Our order book in UK already is quite good.
So you'll see a significant 100 odd crore in the next 2 to 3 years you'll see from the UK. What's the revenue growth clip that you're penciling in, Prateek, over the next 2 to 3 years? Because the base year of FY26 is obviously very low. At 875 in FY27, how does it ramp up? Give us a sense.
So we are planning from 875 to close to 1500 crore in 4 to 5 years time.
In 5 years' time. Okay. Point taken. Prateek, thank you so much. This gives us a lot of perspective. And the 13 to 14% PAT aspiration looks extremely strong. PAT margin aspiration, I correct myself. PAT margin aspiration looks extremely strong if you do land up executing that 1500 crore in terms of top line in the next 4 to 5 years. Wishing you all the very best, and I'll stay in touch with you.
Okay, and you should understand that we have achieved 12.5% PAT margins before, so it is achievable.
That's correct. That is correct. That is correct. Yes, we did highlight that as part of the analysis we did prior to you coming on board. So thank you so much, though, Prateek, for coming in and speaking with us.
Thank you.
All right, viewers, that's all the time we have, unfortunately, on this edition of All About Your Company. Thanks for tuning in. Stay with us. More action on the other side.